When you build wealth, you don't get to build it in a vacuum. Your capital sits exposed to unpredictable forces, sudden market contractions, aggressive liability lawsuits, and unseen estate taxes that chip away at the foundation. For decades, the standard mutual fund has been the default vehicle to grow that money. It is highly efficient and designed to capture pure market growth over time. To capture that growth, a mutual fund requires total exposure to the market. This makes the entire account vulnerable to sudden market crashes, personal liability lawsuits, or heavy estate fees. Enter the segregated fund. It holds the same underlying investments as a mutual fund, but it places them entirely inside a life insurance contract. This insurance wrapper shifts the legal standing of your capital. You are choosing to exchange a fraction of your potential yield for a contract that guarantees your principal. We are going to put these two vehicles side by side to determine exactly when a standard mutual fund is the superior choice and exactly when a segregated fund becomes a necessary financial defense. This choice is rarely a simple math problem about which account posts the highest gross return. It requires you to weigh the very real cost of higher management fees against the peace of mind of an impenetrable legal and estate planning shield. The primary mechanical benefit of that insurance wrapper is the maturity and death guarantee. The contract legally protects 75% to 100% of your invested capital when the fund matures or when you pass away. This chart illustrates exactly how that functions during a severe market crash. While the unprotected mutual fund dives deep into the red, the segregated fund hits a hard, guaranteed floor, protecting the bulk of your initial deposit from the panic. And during a multi-year bull market, that floor does not have to remain anchored to your initial deposit. Many segregated funds offer a feature called annual resets. If your portfolio has a strong year, you can lock in those gains. Your guaranteed minimum payout floor moves up, systematically securing a higher baseline over time. The trade-off for these guarantees is the management expense ratio, or MER. To maintain the insurance wrapper, you will pay a higher annual percentage than you would for a standard mutual fund or an index ETF. Over a multi-decade timeline, that elevated fee creates a continuous drag on your raw compound growth. If you are 30 years old and have the time to ride out major market corrections, paying for that guarantee is usually an unnecessary expense. But if you are within 5 years of retirement and need to draw down that cash soon, that safety net prevents catastrophic losses you simply don't have the time to recover from. Let's look at what happens at the end of life. Standard mutual funds become part of your estate upon death. That triggers probate, a notoriously public, time-consuming, and expensive legal process to execute your will. Because a segregated fund is legally an insurance contract, it comes with a direct beneficiary designation. That single feature allows your capital to bypass the estate entirely. It pays out confidentially directly to your heirs, usually settling in a matter of weeks rather than grinding through the courts for months or years. This side-by-side waterfall chart shows the real-world financial destruction of the probate process. On the left, we start with a standard mutual fund, valued at $213,000. On the right, a segregated fund, starting slightly lower at $209,000 due to those higher management fees we discussed. Watch what happens when the mutual fund enters the estate. You lose up to 1.5% to probate taxes, another 5% to professional and legal fees, and up to 6% to the estate executor. Meanwhile, the segregated fund ignores the estate process entirely. It transfers its full $209,000 value completely intact, with zero estate deductions. A standard mutual fund might show slightly higher gross accumulation on your statement while you are alive, but by systematically avoiding probate and executor fees, the actual net transfer your family receives can be significantly larger with a segregated fund. Segregated funds provide a separate set of protections for your active career, particularly if you are a small business owner or an incorporated professional. If you operate in those roles, you carry the heavy, constant threat of personal bankruptcy or aggressive liability lawsuits tied to your work. Standard mutual funds and bank accounts are classified as liquid personal assets. In the event of a lawsuit or creditor action, those accounts are legally exposed. They are the first targets for seizure. The insurance wrapper around a segregated fund acts as a legal firewall. When structured correctly, it can fully shield your invested assets from seizure. To activate this shield, you must meet strict operational rules. Primarily, you have to designate a favored class beneficiary, meaning the beneficiary on the contract must be a spouse, child, parent, or grandchild. For business owners, the higher MER of a segregated fund stops being viewed as a drag on investment growth. Instead, it functions as a critical legal insurance premium, protecting personal life savings from professional ruin. There is no universal best choice between these two vehicles. There is only the correct match for your specific timeline and risk profile. This quadrant chart plots out the decision. On the bottom axis, we have your sensitivity to investment fees. On the vertical axis, your need for legal and estate protection. Let's map Profile 1, the fee-sensitive accumulator. You are a younger employee with a long investment horizon and very low liability risk. Avoid segregated funds. Stick to standard mutual funds or ETFs to keep your costs low and maximize your raw compound growth over time. Profile 2 is the legacy planner. You are nearing retirement. Your primary goal is preserving a guaranteed inheritance for your kids and avoiding the delays of probate. For you, segregated funds are optimal. The ability to lock in market gains and completely bypass estate taxes easily justifies the higher management fee. Finally, Profile 3, the business owner. You are an incorporated professional or sole proprietor whose personal assets are highly exposed to litigation. Segregated funds are essential for you. They act as a non-negotiable legal firewall separating your personal wealth from your professional liability. The rule is straightforward. If you are purely building new wealth with decades to go, keep your fees low. But if you hold existing wealth that you cannot afford to lose to courts, creditors, or crashes, it is time to secure the shield.